We're back with another Wealth Wednesday, and with the end of the year coming up, it's time to talk those last-minute tax moves before January 1st.
That's right, especially for those who haven't retired yet. Our friend and private wealth advisor, Will Rogers, is back with us this morning to talk about how you might be able to help yourself with these 5 steps if you haven't retired.
Good to see you.
Yes, no, because next week we'll be talking for the retirees, different strategies, but for the folks that are still working and punching the clock, just a few things that might save you a little bit of bling come tax time next year.
All righty. Well, Will, for someone who hasn't yet retired, what are some of the areas they should look at to reduce their taxes?
So the big areas we'll be looking at today is first deductions and then donations. And we'll take a look at, I said the donations with healthcare, flexible savings accounts, and then conversions and dollars.
Okay.
All right. Let's talk here about deductions. What can viewers do to maximize their value of their deductions?
Well, so let's start with the standard deduction that you have just kind of coming to you. It's $17,500 for a single person, $31,500 married, and so if you don't give more than that, it doesn't really help you. And say you give you're a married couple and you give $20,000 to charities and so forth each year. Okay, that's not going to help you. But if you give all those donations in one year, bundle them.
Okay.
Now you're at $40,000. You're above that $31,500 threshold. And then you use a standard deduction the other year. You might be able to time some of the property taxes, prepay some of your income taxes. So the idea being, put all your donations and deductible expenses in odd years, and then just do nothing the even years and just use a standard deduction.
Right. Okay, so speaking of donations, how can you get the most out of a donation?
So with a donation, whether you get the itemized deductions or not, if you give appreciated stock, you're giving away the taxes on that gain as well. And the charity doesn't have to pay them. Charity's tax exempt. So when donating appreciated stock, you kind of get a double tax deduction. You get the deduction if you can itemize the deductions, but you're avoiding that gain. And we've had a 4-year bull market, folks. You might have stocks, mutual funds that have appreciated, and most charities are set up to receive donations. This is something I helped a client with just this week, donating appreciated stock to a charity of their choice. And so it works and it's easy. And again, if you can itemize your deductions, it still counts towards your itemized deductions.
Okay. Losses. Can this actually help you as a taxpayer?
It sure can. So this is the inverse. Say you purchased an investment, stock, mutual fund, what have you, and it's lost money. You can deduct up to $3,000 of regular income and unlimited amount of capital gain income. So if you have losses, go through your portfolio and say you've got a very well diversified portfolio and 20 out of your 24 holdings are up, 2 are flat but 2 are down.
Right.
Maybe you sell those 2 that are down to generate those losses, and then you save some money come tax time.
And you carry on.
Yes.
Okay.
How would converting to a Roth IRA reduce taxes?
Well, and I want to be real clear with this. Initially, it's going to cost you money in taxes. So it's not going to help you this year, but down the line, if you're in a lower tax bracket now than you anticipate being in the future, say there's been layoff at work, slow times, if you've just retired but haven't started Social Security, you can convert that money to the IRA, to the Roth IRA, but then that grows tax-free, so when you pull it out in the future, you're paying less money in taxes in your 60s and 70s. And this is something, especially if we got younger workers that are in between jobs,
right.
And you only worked half the year and you're still looking for something, if you've got that 401k that you might convert to an IRA, to a Roth IRA, that is something that yes, it is a tax bill today. I want to be super clear. It's a tax bill today that might be very modest and save you a lot of money in taxes in the future.
Okay, so you're paying a little to save a lot later
Yes.
on. Okay.
Yes.
You mentioned flexible spending accounts. What about the bucks in those? Because I know those don't carry over, right?
That's exactly my point. It's use or lose. So if you've got dollars in your flexible spending account, you want to look for what medical or dental expenses it can use. And they've expanded what you can take these out for. So check with your human resources department, see what your particular plan allows. But my big one is if you wear glasses or contact lenses, get an extra set of frames or maybe sunglass with corrective lenses. Great way to burn up some of those dollars that might be in there. But that's money that you got a deduction for putting in, but it comes out tax-free.
Very good. Okay.
go.
So, Will, what are we going to be talking about next week?
So next week it's the other side of the coin for folks that have retired. So we're going to look at 5 things that retirees can do to save taxes before year end, and again, have more bling in their checking account come April.
So it's not too late.
Right.
We all
Okay.
want that.
Always good to see you, Will. We appreciate the info.
Yeah, thank
Thanks
you.
very much.
No, and Baxter's enjoyed himself as well.
We'll see you next
Thanks,
Wednesday.
Baxter.
See you then.